state issues. With remote workers and COVID, a lot more people are working remotely. The tax implications of that can be pretty significant if you aren't paying attention. And another part is that you aren't letting your tax preparer know that you have remote employees. So a few things to talk about. I found a statistic that said 34% of establishments increased telework for some or all employees nationwide in 2021. The general rule is that you withhold taxes where the employee performed the services. However, note that the convenience of employer states, which PA is included in that. So whereas normally employees working for an employer located in another state would be subject to income taxes where they live. However, if you live in Pennsylvania, we have a convenience of the employer rule. I'm just going to read what it says on the slide. The rule states that if the employer requires the employee to work in another state for the employer's convenience, then withholding is only taken in the location where the work is performed. If, however, the employee chooses to work in another location for the employee's convenience, then withholding must usually be made in both locations. So let me explain that just quickly. So in Pennsylvania, if your employer requires you to work out of state, your withholding on your paycheck will be where the work is performed. However, if it is your choice to work either at home or in the office, then per PA, the withholding, we must withhold Pennsylvania taxes. And then the state where you are working may also require withholding. So therefore, if you are working out of state and you could have withholding in both locations. So if you are on the employer side of that, you need to understand that rule so you are withholding the correct amount from the employee's paycheck. I do have some graphics up there that just shows when must the non-resident employer withhold. That's the top one. So it depends on how many days. Some states depend on how many days you're in that state, and some don't have any threshold at all. The other thing to look out for is that employers should really be documenting where each employee's remote work arrangements in the past, the present, and the future, and share this information with your tax preparer so that we can help you consider, the tax consequences of your remote employees. On the flip side of that, not only do your employees have certain requirements, as far as withholding and filing in the states where they're living and working, but you as an employer, that could affect where your business is being taxed. Nexus is defined as a relationship or connection between two parties. Tax nexus is thus a situation where a business has a presence in a particular state, which establishes the connection between the state's taxing authority and the business. So now that you have remote workers, you could have filing requirements in states where you previously did not. A lot of states are implementing economic nexus, which means that if you exceed certain levels of in-state sales, for example, 500,000, businesses will be required to collect and remit sales tax, and in certain states file a corporate income tax return. So two things you need to look out for is where are your sales and where are your employees? And you need to share that information with your tax preparer so that we can help assess where you have, where you might be liable for either collecting sales tax or paying income tax. So noting that a lot of the COVID rules have temporary COVID rules for remote workers have expired. You're now back to pre-COVID where states are going to be looking out for that. And so I just have on the next slide a list of I put local states, surrounding states, and then some of the larger states and the impact of remote workers on Nexus. So as you can see in all of the ones that I picked, that if you have a telecommuter or a work from home office, it automatically creates Nexus, and that opens your business up to additional taxes, including sales tax and income tax filing requirements. So again, share that information with your tax preparer so we can help you through that. Again, some other things to consider are just apportionment, payroll factors, receipt factors, where is it being sourced, and all of that information can be affected by not only sales, but also payroll. The Wayfair effect, I'm sure we are all aware of the Wayfair case. And what happened is that states started implementing economic nexus provisions. So my first bullet point up there, effective 2023, every single state imposing a sales and use tax have enacted economic nexus provisions in some form, applying to remote sellers and marketplace providers, meaning you no longer have to have a physical presence in their state. You can have an economic presence, and you will be required to file or collect sales tax. There are bright line sales thresholds. PA's threshold is 500,000 or more of direct or indirect gross receipts sourced to PA. We have Nexus here. Ohio, Nexus is created of 50,000 of property, payroll, or 500,000 of gross receipts. There is a case out there that is arguing that this is unconstitutional. The U.S. District Court refused to hear the case, but this case still isn't over. They can appeal or refile in state court. U.S. District Court did not feel that it had jurisdiction, so it may go back to the states. Just to give you a sense of how things are changing, that first slide there shows the sales tax economic nexus footprint just, 4 years ago. As of this year, you can see that the environment is changing and then the income tax is following. Lastly, I just wanted to go over the pass-through entity taxes. This was created in the tax jobs, or TCJA limited the state and local tax deduction to $10,000 per person, beginning with the 18 year. So to counter that, states enacted laws that created an entity level tax on pass-through entities so that your pass-through entity pays the tax instead of the individual. Therefore, you get a ordinary deduction on the business return, and you actually get a benefit from that tax. Each state we have 15 states as of 2021 that adopted their own state pass-through entity regimes, and then in 2022, 8 more passed. Pennsylvania is missing from this list. It was introduced but has not advanced during the legislative session of this year. We'll see if that changes in the years to come. This does need to be evaluated on a business by business and shareholder by shareholder level. It affects each shareholder differently, but it is something that should be considered if you have out of state filings. And then that's it for me. So again, we will be monitoring that pass-through entity tax for you and reaching out to those clients where we think that this might benefit you, and we will do an analysis on a partner by partner, shareholder by shareholder level. One other thing I just wanted to note on this is that last line there, is that you can get a state credit for taxes paid to another jurisdiction. However, for PA, the credit is only allowed if it's paid by an S Corp. It is not allowed if it is paid by a partnership or an LLC taxes partnership for some odd reason.